Hey guys, welcome back to another week of the Educated Homebuyer Live. This is where Josh and I answer your mortgage and real estate questions to help you become the educated homebuyer. This week, we're starting off hopefully with the mics working. Let us know in the
No
comments
silence.
if you can hear us. Let us know where you're watching from. And also just want to send some prayers, positive vibes out to Florida. Hurricanes going through there about the time this show's coming on right now. So we're thinking about you guys. We hope all is well out there, and hope you guys make it through with nothing crazy happening. So, Josh, this past week, what have we seen? Not a lot of data, but since we get the data last Friday. Was it last Friday?
We got the kick in the punch in the gut on Friday. Again, it's another one of these reports that just doesn't square with anything else that the government or private companies are putting out. ADP was a little hot on Wednesday. We get the NFP report on Friday, super hot, at least at the top level. When you dig into it, which no one in the media or apparently in the markets actually does, and we'll talk about this. When you dig into it, it wasn't nearly as strong as people are worrying and fearing. But it is what it is. For now, it took the wind out of the sails of the interest rate market and a lot of the refinance activity that was going on.
Yeah, rates, I mean, have gone up probably 0.5% or more from some of the lows we saw. So with that, we've seen inventory pick up. It hasn't bottomed out yet, which we're going to take a look at today as we dive into some of the charts. But while we're doing that, again, let us know where you're watching from. Start putting your questions in the chat so that when we're done with that, we can answer them. And we'll get started. So, Josh, this is where we like to start, which is inventory. And this week we saw it continue to increase. We have not seen the peak as of yet. We're currently sitting at 734,200. What are you doing over there, Josh? What's going on your side?
Somehow I have two sets of speakers, both the ones coming in my ears and the ones coming out of the computer.
I am trying to educate people.
I'm trying
to
disrupt
you. Are listening to something else.
You're listening to the radio over there. I'm throwing curveballs at you, brother.
Inventory sitting at 734,290 new single-family homes. That's up from 731,000 last week. Huntington Beach, and Orange County, we are below the peak. But we did increase week over week. So Orange County sitting at 3,627 homes, which was up just less than 1% week over week. And Huntington Beach sitting at 231, which was up 1.73%, but both below the peaks. We've got to be getting close, Josh. Got to be getting close to those numbers just because of the time of the year, but we will see. So this is taken from Calculated Risk. We like to show it. This is from the first week in September. So the data is a couple of weeks old, but we'll continue to update you as these reports go out. I like them because they show inventory in certain markets year over year versus 2019. As you can see, mostly every market, in fact, all of these markets shown here are up year over year. But compared to 2019, you've got Denver up nearly 20% with inventory, Nashville up nearly 15%, and the other markets that we're talking about here and some of areas in general, just the Northwest is an area that they're considering still down compared to those 2019 levels. And that's going to take us into new listings. So new listings added about 60,655 new listings this past week. A little bit more than 2023, below where we were in 2022. And then that's going to put us into a similar chart here showing those same markets with new listings. So new listings, all of them are up year over year except for Portland, but pretty much down versus 2019 levels. And the reason we don't have new listings coming to the market, part of it is seasonal, part of it is affordability rates. A lot of those things are playing into it. So we're just not seeing a lot of inventory come to the market. So you ask, how does inventory grow when you don't have new listings coming to the markets? Because homes sit longer. They don't sell as quickly. So you've got inventory building in that way. And you'll see that when we start looking at price cuts. So weekly inventory change went from 731 to 734. The peak at the moment is still sitting at 734. For context, back in 2015, we were at 1,160,something thousand homes. So quite a bit less than where we are today, but we are seeing inventory continuing to grow as the housing market slows. So this is taking a 1-year change in active inventory, September of last year versus September of now. The darker the green, the more inventory is increasing versus some of the browner colors in there. The tans, the beiges, those are where inventory has actually gone the other direction. And you're not really seeing a lot of those markets. There's some in Nevada, Montana, South Dakota, Idaho. Some of these markets are more like rural areas, country areas where just you don't see the inventory pick up, like you do in some of the metropolitan markets. So in those markets, kind of to be expected. But if you look at Alaska, same thing. I don't know Alaska well enough to tell you what those areas look like, but I would imagine they're probably desolate. Contracts pending. So contracts pending, 354,000, 816,000. That's compared to 326 back in 2023 and 358 in 2022. So we're between where we were in 23 and 22. But at the moment, probably going to see pendings go down, Josh, just because of where rates are. And we're going to talk more about that. But price reduction sitting at 39.5% compared to 38% last year and 42% in 2022. So again, between those numbers, and maybe we've seen the top in price reductions, but it's hard to say. And then that puts us into mortgages, Josh. Talking about the average age, how long someone keeps a mortgage. I believe at the moment it's about 5.5 years or so, right?
Yeah, so it shows you 70 months there. We've hit, so what, 7 years would be 84. So almost approaching 6 years. And if you look, leading from 23 or 2013, we were about 5 years. And remember, first that was really the first big wave of QE. So a lot of people were refinancing, but home prices were lower, loan amounts were lower. So some people, even though the interest rate benefit was there, wasn't big enough loan to make it worth taking on closing costs. So settled into sort of that 65-month range, and it all ran down during the pandemic refi boom, and we're back up to a higher level for the reasons that you talked about. Most everyone, like we've never had a period of time quite like COVID. We pulled forward a bunch of demand. A lot of people who would have bought in the next 1, 2, 3 years bought early to take advantage of lower prices relative to now and much lower interest rates. But then those that were in homes refinance to much lower interest rates. So we have a lot of lock-in, a lot of people in homes with great rates that they don't want to give up. So it'll be interesting to see how high that number can go over time, because most people are somewhere they're happy with. So this is that jobs report, Jeb. I should have put the chart in both ways. If I show you this, just you'll see here where it says 1 year, 3 year, 5 year at the top of that chart. You can just kind of click on it. And as you go across, if you look at the 1 year, you go, oh my God, that was quite a blockbuster report that we got last Friday. But you look here, I put this, it's funny, I have it from 2021 going forward, because if you include COVID, the giant drop in non-farm payroll and then the giant spike coming out of it makes everything else just look like a flat line, both leading into and out of it. But as you can see, jobs growth has been on a steady downtrend. We have some noise in the data last month. And again, this isn't, so if you look, that's 150 to 200,000 monthly job creations. So this is not the type of economy where you're going, oh, this sucks, no one can get a job, everything's terrible. But we've talked about a lot of the internals not getting the same sort of news play. So what were the internals here? We had a shorter work week, so people were working less hours. So when you look at it, we're going to look, and you see, according to the Atlanta Fed's GDP now, they're projecting that GDP is at 3.2% right now. Well, if GDP is going up and you've got shorter hourly work weeks, the only thing that could be increasing there is productivity. So we don't have a huge increase in wages. When you look at them, you're seeing the month over month changes in wages, but when you see the hourly or the average hours worked decreasing, the total wages, take home pay for the average worker is not increasing. So in looking at that, really led by three and a half major areas. So construction down there is always a good bellwether for what's going on in the economy. When things are booming, construction jobs are hot. So it's the fourth biggest creator of jobs right now. And a lot of that is the ironically named inflation. What was it? The Inflation Buster Act that we passed. Yeah. That was basically let's spend a bunch of money to kill inflation. But we have a lot of government construction going on. That's not so much in residential. But if you see government jobs, 31%, leisure and hospitality, 78%, private education and health services at 81%. It's just the relative contribution in terms of thousands of jobs last month. So leisure and hospitality, those are generally not the highest paying jobs. Private education, could that be back to school? There were some really wonky seasonal adjustments in that data. So it will be interesting to see going forward. Jeb, I don't know if you were able to listen to the Housing Wire podcast. It was either Friday or Monday with Logan, basically saying, do I think that this will get revised down? Yes. Do I think there are some aberrations in there? Yes. But to see rates move any lower from where we were at, you have to see a breaking jobs market, which we're nowhere near that. This may not be the greatest, but it certainly isn't bad. Talked a little bit about this. You see, almost every analyst that I follow looks at this number and they go, all of the internals, when we're looking at the regional Fed beige books that they put out, everything tells us this might be a 2% growth economy, but every week they keep revising this number up, and they're not cooking the books. There's a methodology that they use. So it will be interesting going forward, because the only thing that could be driving this is productivity gains. And is it AI? Magically, everyone's that much more productive using AI. This week, Jeb, the big one, tomorrow morning, we're going to get CPI. We've talked about inflation is taking a backseat to employment right now, but it is an important measure. Should get a decent look tomorrow, 0.11 month over month on the headline, and then 0.27 on the core. So that 0.11 month over month is great. Puts you a little under 1.5% annually. That 0.27 is up over 3% annually. So much better than where we were a year ago, but not necessarily where we want to go. So if we hope to turn around what we've seen over the last week, a big surprise to lower inflation tomorrow would go a long ways towards helping. Thought I would throw this one in here. We talk about the U.S. economy cooling but not collapsing. So again, we get this hot jobs report, and every headline for the last week is, hey, the economy's great, it's resilient, everyone locked in super low interest rates, so the Fed hikes haven't had the impact. So we go from 6 or 8 weeks ago. If you remember, Jeb, like 3 weeks prior to the Fed meeting, there were people literally calling for an emergency cut, intermeeting cut from the Fed. And now we go back and we see these headlines are saying, oh, this economy is just incredibly resilient. It is not a bad economy. It is not terrible. But when you look at this, real disposable income, 3.1 a year ago. So year over year percent change down to 3.1%. A year ago, it was 4.7. Real GDP, 2.5. It was 2.9. Exports are up better than where they were. Payroll employment, 1.6% year over year versus 2%. Real average weekly earnings up a little bit more than they were last year, but index of aggregate hours worked. That's what we're talking. So hourly earnings are up, but the hours worked are down. So people are actually making less. Auto sales way down. Household employment down. Industrial production relatively flat. All of these things tell you the economy is obviously not collapsing, but anytime you get this crazy reaction to a jobs report like we had last week, it's like, oh my God, the economy is hot. The Fed was crazy. Why did they cut 50 basis points? We're going to need more data, and everyone should be data dependent, but the data is slowly trending down. Wanted to throw this one in here, Jeb. This is the spreads between 30-year treasuries or 10-year treasuries and 30-year fixed rate mortgages. And we like to measure this with the Optimal Blue Mortgage Market Index. That data is in Fred. We're at about 2.3% right now. So when you look at it, much of the improvement that we've seen in interest rates is not so much coming from treasuries. So we saw the 10-year treasury peak at 5. We had got down to 3.7 or so. So that's a nice improvement of 1.3. But when you look here, we were at 3% on these spreads for a long time, and we haven't given much of that back. We're still sitting there at about a 2.3. Tells me that mortgage lenders are getting more aggressive and saying, hey, servicing values and servicing rights may not be where we want them yet. But if we want volume, we're going to have to get the volume by being competitive on pricing. So that'll be important to watch. If that trends back up, if rates trend up, the 10-year goes up, and you see spreads go back up, rates could get worse than what we see. This is that same thing we were looking at. Jeb, you weren't here last week, but we looked at this wonderful chart, and we looked at our channel, and we were at the top of that channel, and my green arrow was there and saying, the most likely thing to happen at the top of the channel is to reverse and to go back down. But you do occasionally get breakouts, and we definitely saw a breakout this week. So I went in just super simple through that trend line up on the top of the chart, and you can see we've got a good ways to go before we hit that longer term trend line. In terms of the other stuff there, I think I've got a 20-day moving average, a 50-day, 100, and a 200, and we kind of blew through all of them. So the yellow line should be the 200-day moving average. We need the 10-year to stay under that 200-day moving average. It would be really nice if we got a good CPI report tomorrow that moves things back in the right direction. I don't like just reading stuff here, but I thought this was instructive that you guys might like. One of my morning reports that I read when I get up in the morning, David Rosenberg writes it at like 4 a.m., well before anyone in the world gets up. But he is very bullish on interest rates, thinking that treasuries are going to go higher in price, much lower in yield. But with that, he said, we did the math and found that the current 4% plus yield on the 10-year treasury is coinciding with an expectation that the Fed still cuts rates 150 basis points by the end of next year. All that it has taken for the 10-year note yield to pop more than 35 basis points, so from that 3.7 to about 4.05 over the last couple of weeks, was for the swaps market to price out one 25 basis point cut. So we had talked that in the futures market, they were expecting 75 basis points in cuts before the end of the year, where the Fed is saying 50. Well, now they're pretty much both in line, still saying 50, but that 25 basis points goes away. You say, now imagine if the Fed stops and paused indefinitely. So if in fact the trend on real GDP growth remains north of 3%, the unemployment rate stops rising or goes down from here, or out of the blue, the downtrend in inflation stalls out, given what is priced in. If this were to happen, a recalibration in the bond market would take the 10-year to 4.8. That is what falls out of our analysis. Not a base case, meaning not what they think is going to happen, but that is what would happen if you get another hot jobs report, if inflation sort of stalls out here. So if we're at 405, that's 0.75% higher. So we, Jeb, you and I, and what we were going to record this week for the podcast was, how low can rates go? An analysis, what can happen on the downside? There's kind of someone's very educated analysis on what could be the worst thing that can happen. So really, our projection going forward for the next 1 to 2 years, worst case, somewhere up in that 4 3/4 range, best case, somewhere around 2 1/4. That's a pretty big range when we're sitting there and trying to plan and make decisions going forward. So we saw lots of beautiful green arrows on this chart for weeks on end, and now we're seeing nothing but red. So the day over day change, not bad, but like you said earlier, Jeb, about 0.5% up week over week, about 0.5% up from a month ago because they'd been flat for a good period of time. Still down a bunch from last year. So I wanted to throw that chart in so we can absolutely see there is a downtrend going on, a very solid downtrend, but a correction within that downtrend that we would like to see go away very soon. With that, we talk a little bit about, you guys don't really care how many homes are sold or how many mortgages are being done unless you're buying the home or you're getting the mortgage. But with this, John Burns Research and Consulting, they surveyed consumers and they said, what is the highest rate you would accept on your next home purchase? So meaning, when would you be in the market? What rate would it take for you to be in? So 47% is 5 to 5.5. And we were getting close to that. We had people 5.625, 5 3/4. And if you wanted to pay some points, could have got it down under that range. But before we really saw any pop in sales volume, kind of went away. So when we look at that, we still have some room to go to get rates lower before people would act. And then the last look at it here, Jeb, is number of mortgages in the money for a refinance under various interest rate scenarios. So 6.13, about where rates were this time last week, 4.3 million people could benefit from a refinance. They have a big enough loan at a high enough rate that it makes sense. And now if you're at 6.5, it goes down to about 2.5 million. So about half of the people that were in the market for a refinance a week ago, it no longer makes sense. Now, if we do get down to that 5.5 range, you're going to have twice as many or nearly twice as many people as were at 6.04 or 6.05.
All right. And then you got one more chart here. So here are the states that we can help. It's the entire U.S. The red states are where Josh is licensed and can take care of you through our team here. The blue states will refer you out to one of our referral partners, David, who can guide you through the process. So if we could be of assistance, refinancing, need a discussion on a loan estimate you've received, see if it's a good deal, reach out, use that referral link that's scrolling the bottom there, and we will take care of you and guide you in the right direction. So, Josh, the title of this episode is "The Housing Market is Slowing," and one of the questions I often get as a real estate agent anytime you say you're a real estate agent, the very first question somebody asks is, how's the market? How's the market? Market's slowing down. Part of it's seasonal, right? The market typically slows down this time of year. Kind of an anomaly. People have short memories. The last 3 years or so, the market hasn't really slowed down so much. I mean, we did have the peak in interest rates last year, so there was a little bit of seasonal slowdown, but as we moved toward the end of the year, it picked up again because rates kind of got off those highs, and people were like, okay, I better take advantage of it. That said, partly seasonal, partly the market sucks. It's rates haven't come down in a meaningful way for most people. Prices are still high in most markets. Inventory in some markets has increased. So if you're in Florida, Texas, parts of Louisiana, we've looked at some of these markets. There are, I think, 7 or 8 markets now that are back to 2019 levels. So those markets are the ones that slow down. But here in Orange County, what I'm seeing is just kind of a gradual blah market. You're seeing homes that are priced high, right? I see some of these. I look at homes that come on the market every day, and I'm like, my God, that thing is way overpriced. I mean, there's one in my community that's easily $150,000 over what it should be. And I mean, we're talking it should be 1.5. It's listed at $1,650,000. So what's that? I mean, that's, over 10%. That's nuts.
Well, Jeb, I don't know if you've seen the one in my neighborhood. There was a full flip. Someone gutted it, did a beautiful job on the interior. Outside, got paint and a little bit of landscaping, but the inside, gorgeous. Sells for $2.2 million. On the cul-de-sac right across the street from it, a model that is smaller, so less square footage, 2-car garage instead of a 3-car garage, and it's probably the least desirable floor plan in our development. And these people over the last 5 years have done a bunch of work to it. Didn't do a bad job, but not like perfect brand new designer custom work. And magically they want $2.2 million also because that guy paid it for his house, and they've had 2 price cuts already because what I'm seeing is the beautiful homes, the desirable homes, the few buyers that are out there, instead of going, hey, I can get a deal on this, they're all going and competing for the few nice properties, and the ones that aren't as great, anecdotally, and be very careful because your mileage may vary in your neighborhood and your market, but in our market, at least the portion that I pay attention to, that's what I'm seeing.
No, it's definitely slowing down. Is it crashing? No, it's not crashing, but it's slowing down. And I think as rates move lower, which they're going to, right? Is it going to be next week? I mean, I'm going to go out, Josh, on a limb and say that CPI tomorrow, even if better than expected, you don't see a big move to the 10-year. Just personally speaking, I think, could it go down? Sure. Is it going to be meaningful? I don't think so. Just because I truly think the market now wants to see employment. They are focused solely on employment because they know inflation's coming down. Is it 2%? No, it's not 2%, but they know it's not going to jump back up again, at least in the short term. So maybe I'm wrong. Maybe I'm
right. But why? Why are we looking at these things? Employment matters to the extent that it impacts inflation. If we could have 0% unemployment, the market for bonds wouldn't care about that. They care about it slowing because the worry is that it will lead to inflation. So at some point,
recession, I think, is more important in the big.
But again, what is a recession? It's very low growth. Employers lay people off, so people have less. There is less gross domestic income. We talk about GDP, but gross domestic income that gets spread around to families to spend. So it's you can't have one without the other, and we're getting just conflicting messages. So it's like, we're going to look at this, or no, we're only going to look at this. They all go together. There's no magic. We don't have a hot jobs market that, when we're looking at JOLTS, Challenger, ADP, you look at the Beige Book, you look at employers' plans in their surveys. We've got just crazy things that don't line up. So over time, you can put out whatever you want every month, but over time, the truth is going to bear out, and we'll see that. And an important thing to note, when we're talking about GDP, if you go back and look in 2000, right before the tech wreck, if you look in 2008, right before the great financial crisis, we had well above expected GDP numbers, and people in the press going, hey, this economy is really resilient. And 3 months later, you're like, oh my God, wasn't so resilient. Not predicting that, because we've talked about on the show here a million times. Markets can remain irrational longer than you can remain solvent if you want to sit here and bet against it. So anything can happen. I am not in any way saying that you're wrong, that CPI could come in super low tomorrow and just get ignored because it's not employment data. But over the long haul, it's absolutely not going to get ignored.
No, and when I say get ignored, I'm saying we're not. I mean, again, it's not going to send us back to the 3.7 levels, 3.8 levels on the 10-year. You're not going to see that 0.5% we just gained last Friday or the last couple of days go right back down immediately. The expectations that it's going to come in lower probably is. Again, who knows, right? The market is slowing, but like you said, the data doesn't always line up the way we think it should, and therefore, just be patient. Be patient out there when you're looking. Be patient when you're locking loans. Be patient. All of that. Just make decisions based off what you know now and not what you think is going to happen. Because what we think is going to happen has been quite surprising, over time. Over time, it's actually kind of lined up, but in the short term, it's been surprising. So
you just said something really important. Don't myopically focus on 1 week, 1 month of data, because really what we're seeing is we're getting anomalous data to the positive and to the negative. You got to have a 3, 4, 5, 6 month view of this. And when you step back and look at those charts, like we just looked at last week's hot jobs report, was it really? It's kind of in line with the downward trend. But relative to the prior months, the 2 prior months that were really soft reports, absolutely. It was a wonderful, amazing report.
All right, good stuff, guys. So we got Vince watching from Europa Valley, to Larry's in the house, Sarasota, Florida. What else do we've got?
San Francisco Bay Area.
San Francisco.
Did you get Minnesota
in there somewhere.
Yeah,
Minnesota. So appreciate you guys watching. Let us know where you're watching from if you haven't done so already. One of the things I said, Josh, and clearly wasn't paying attention because some people are listening audio when I said the blue states and the red states.
This is the comment of the night.
It says, when you guys say red states and blue states, it didn't quite register accurately in my brain. So earlier I showed the map and I said, we can help in the red states.
And blue, you guys in the blue states are on your own.
The states that we put on the map were red. It was not a political statement. So with that said, go back, look at the map if you need it. But if you have questions, just reach out to us directly. But pretty funny. Right. Red Apples Kim says, happy Wednesday. Don't have a lot of questions, guys. If you have questions, start putting them in the chat. Here's something that I'm going to put up here from Bill, just because, not to point blame at Bill or to him to make the center of attention here, but this is something we talked about. He said he gambled and lost locking his rate because of the jobs report, right? So we always talk about lock when the number makes sense to you, lock when you're comfortable with the payment, and don't try to pick the top or what you think is going to happen, because again, there's craziness out there in some of these numbers. And even this report, if we're being honest, could be entirely wrong and they could revise it next month. I mean, that's unfortunately how this whole thing works to some degree. And it's just like, oh, just brush it off and whatever. But so, it sounds like Bill's taking it in stride and understands that, hey, it's going to increase and it is what it is. But not everybody feels the same way Bill does. And didn't see that increase coming. And now they're probably shocked with where rates have gone.
A couple of reactions to that. One is, know your risk tolerance and how comfortable you would be with being wrong. So people that are like, no, I'm not a gambler, I don't like to risk at all, and if I lost $1 or 0.01% in my rate, that's going to stick in my throat for the rest of my life, just lock your interest rate. We knew going into last Friday there was some risk there. The hope was, hey, this is going to be more confirmation that things are slowing and it's just going to run rates even lower. So when you lock a rate, if that happens, you're on the wrong side of it and you're losing out on some gains, but you have to know yourself on the way in. And then the second piece, now with the increase, I'm going to be paying thousands more for points. You don't have to, unless you have to have that rate to qualify. You can take a higher interest rate. You can still do it 0 points. You can keep that money in your pocket. And the question just becomes, what do you think happens bigger, longer term? Are we going to not ever see rates back down lower? I don't think that to be the case. But again, nobody has a crystal ball here. We analyze the data week by week, month by month, day by day, and try and figure out for ourselves what we think is going forward. And at the end of the day, just like you have to buy a house when the decision and the time is right in your life, you've got to make these decisions for yourself, what your comfort level is.
All right, good. We got Irvine in the house, Cape Coral, Southeast Pennsylvania, also Okinawa. I think they win.
Furthest away.
Yeah, well, the fact that they're watching, it's got to be at least 12 hours difference from here and there. So, early in the morning over there, you're going to type it up, tell us what time.
9:29 a.m.
There you go. Early in the morning on the tomorrow. It's already
So
tomorrow.
what happens tomorrow? I'm dying to know.
What happened overnight? Let us know. We'd like to trade on those futures. But no, we got a question here from Orange Pulp. It says, noticing recent list don't include sales history. Used to see this. Are they paying not to show this? I don't know what site you're looking at. Sales history, as far as I know, still shows up on all the sites out there, unless the site algorithms have changed. I only use the MLS, so I don't use sites like Zillow and Redfin and those guys. But as far as I know, they're still showing all that information. I mean, that's part of what people use for those, those sites for. So would imagine it's still the same. But if I'm not answering your question specifically or what you're asking, let me know and I'll try to address it a little bit better. DCF says, not a question, but has a comment. Just says prices have been sticky in my area, especially the suburbs within a 30-mile radius of Philadelphia. So one thing we have noticed in the data out there, a couple of guys we follow that do nationwide stuff, is that the Northeast, I'm throwing Pennsylvania into the Northeast, although it's not technically, I guess, all the way up there. Those markets are still strong. Like north of Maryland, like those markets still, low inventory, demand is still there, things are still moving. And again, it's that lack of supply, got more demand than you have supply, pushes prices up, keeps prices sticky, all of the things that we talk about constantly. Let's see. We got Kim asking us a question.
Before we do that, let's go to that, but let's stick with DCF. It says, I keep hearing it's a buyer's market. I'm not seeing it. What is the definition of a buyer's market? And not just the definition, when you're out and you're working with buyers and they ask questions like that, hey, is it a buyer's market or a seller's market? What are you talking to them about? What should they be looking at? And how does it differ for how they should be thinking about the market?
When I think of buyer's market and seller's market, I think of, supply versus demand, right? Do you have more people out at the moment looking to buy homes than you have willing sellers willing to sell them, right? And hard to say because each area is different, right? We always talk about real estate being local. So that's one way to look at it. I guess the technical definition, if you go back, I don't even know if we say this is technical, but 6 months of supply or more in a market was considered a buyer's market. Less than 6 months of inventory is considered a seller's market. Now, that said, you don't have 6 months supply in most of these markets out there. Could it still be a buyer's market out there? Sure, it could be. Because you got to factor in price points, you got to factor in so many different things. And it varies. Not only does it vary by market, it varies by price point, right? So if you have a huge increase in supply in your market, but it's all at a certain price point and above, and you're below that price point and there's not a lot of inventory, it could technically be a buyer's market above that threshold and a seller's market, or you get the idea, and a seller's market below that threshold. So you've got to pay attention to everything, not only the market that you're in, but you've got to look at the price point that you're in, the neighborhood that you're in, a lot of different factors, and see what's out there. You also got to pay attention to how people are pricing homes. Where's the last comparable sold at? Like, these are all things that go into making the decision of how to address an offer. I mean, an example, got a call from somebody tonight or this afternoon, writing an offer for them. And there was a property listed just over 1.1 million, and they lowered the price to 1.2. And he called me and said, hey, I'm thinking of making an offer at 945. And I'm like, 945? Like, where are you getting the number from? Like, where's that number coming from? So I go up and I look up comps and I say, hey, listen, small community, hasn't been a lot that sold in there in the last however many years, but there was a property, a model match to that home that you're looking at, that sold back in February of 2022 for 970. And so, yeah, the market in some areas of the United States have slowed down since 2022. Here in Orange County, it's gone up at least 10% since 2022, probably more than that. So if you just factored appreciation alone, that home is definitely worth 1.2, I mean 1.02, a million 20 versus, the 945 he's trying to offer. So I'm having that conversation, trying to convey why the number he's telling me is absolutely nuts, and why this is a number that you should consider. So to each person his own. Like, I'm not the one making the decision, but you have to approach things in a reasonable, fair and reasonable way. Otherwise, you get a response back that is not reasonable. Sellers don't like that sort of thing. And if you're okay with it, then so be it. But it's you just got to provide the information and hope somebody takes it and uses it for what it's worth. But anyway, so I'm not sure I answered your question, Josh. I just went
no, just the discussion
soapbox.
is helpful and insightful, because there's not an easy answer, and the textbook answer isn't super relevant. You just got to know your market, and you need to be working with someone that is in the market enough to have a strong feel and handle on it.
All right. Let's see here. We got Blackluster, not Blockluster. I was thinking Blockbuster when I read it initially. Blackluster Soldier. Do we still hold? Giving rates are looking to stall around 6%. We
locked.
We locked at 7% and should have refinanced when we saw 5.6 with no points a few weeks ago. So I guess the question is, are rates going to come back down to a point where you can lock? Probably, but is that going to be a month, 2 months, 6 months? Hard to say. Here's what I will tell you. If it makes sense to refinance at a rate now, 6% or whatever that number is, I don't know. I haven't seen your scenario, but if you can do it with little to no cost, you should probably consider it, because I think, again, the market can remain crazier than we think. I think the expectation is that rates are going to go lower. That's the consensus, the broad consensus nationwide. Now, is that because we all have biases and we want them lower? Maybe a little bit. I think the data out there supports it as well. But could we all be wrong? Sure we could. I mean, to some degree, could it be longer? Absolutely. And I think that's the way you got to think with this sort of thing, because otherwise, you could be waiting longer than you had originally thought.
Jeb, let's look at the discussion we were having 2 or 3 weeks ago. People going, should I do it now? I mean, we all know for a fact rates are going lower. So shouldn't I just wait? And we're saying, if you have $300, $400, $500, $600 of savings on the table and minimal costs that you're going to recoup in 2, 4, 6, 8 months, doesn't it make sense that that is a low-cost insurance policy against being wrong or things changing? Things can change. We could all be right and know that rates are going lower, and something crazy could happen that we're not aware of, and things go the other direction. So I tell people, like, what if it was a 12-month break even, but you're able to drop your payment $400, and in 6 months rates are lower and you do it again? So you wasted 6 months of the savings, $2,400 on a $400 savings. What was a $2,400 insurance policy against being wrong and not feeling like this? So many of the loans that we have going right now, those people, one, feel smart because they locked and moved forward, but they also are like, yeah, I don't care what happens going forward. At least I got this. And the people that didn't lock because they knew rates were going lower, which I agree with you. I think rates are going lower. Nothing that has happened in the last 10 days has changed my mind on that. But it's important to know that these trends, we basically have seen rates going down from May. So May, June, July, August, September, first part of October here. You have almost 6 months of them going one direction. Is it reasonable to think for 1, 2, 3 months they might go the other direction? So in that time that you could have been benefiting from the low payment, you would instead be stressing about, am I ever going to get that opportunity? Is it ever going to come back? And who's to say that on the way down, you don't just decide to lock in when it gets back where it was? Because you're like, oh, thank Jesus, it got back where it was. I'm going to lock there. And that downtrend continues. It is not easy. Like, so I don't say this to think that anyone should sit at home and go, I'm the smartest. I locked at the perfect time. There is not a perfect time to lock. Know yourself, know your situation, know your savings, work with someone that can help you in terms of quantifying, okay, what if this went lower and in 6 months you refinance? What if you lost? Is it $1,200? Is it $1,500? Is that a reasonable insurance policy? A lot of people said yes, and many people didn't and wish they had.
All right, good stuff. With that, guys, here's my advice. If I were a buyer out there in this market and I was willing to buy a home, I was comfortable with the payment, whatever, I would be looking at, again, you have to be comfortable with this. I would be looking at the properties where people bought them less than 6 months ago and tried to do a rehab or did a rehab on them and putting them back on the market. Because my bet is a lot of those people purchase too high and are pricing it at a point where they're probably pricing it too high too. I see those being the opportunities in this market because those people need to get out from under them. a lot of them aren't truly investors. They've got money in it. They need to get it out. I think there's opportunities out there in this market. Could I be wrong? Sure. But I've seen a couple of them where people have done rehabs. Now you got to be comfortable with the shoddy rehab on some of these, because those what you're likely to get. The people that know what they're doing aren't overpaying. Probably they're building this margin in, but there's a lot of people that aren't, and I'm seeing them on the market where they're overpriced. I see they paid too much to start with, and I see those being opportunities. I don't know. That's what I would look at. But you got to be comfortable with the downside of buying something like that too. Josh, I found this to be a good question, something that we often address, but it's something that comes up and can help people actually get qualified. It says, can you borrow against a 401k for a down payment? What are the pitfalls? Or let's address the pitfalls. So explain the difference between borrowing and basically cashing out or pulling money from your 401k.
If you cash out or take a hardship withdrawal and you're not retirement age, so 59 and a half or younger, you're going to pay a 10% penalty, number one, and then you're going to pay taxes on that as ordinary income. So if you have a high income or you're taking a big chunk, it's not unheard of. I see people with $500,000, $600,000, $700,000 in their 401k, and they go, I'm just going to pull 200. Okay, well, 20 grand has gone off the top, and then that 200 is going to get added onto your income. So if you make 100 grand, now you're going to get taxed like you made 300 grand. And there's a pretty significant difference of what that looks like and what you're used to paying taxes on. So from that perspective, you want to stay away from the hardship withdrawal. The loan, horse of a different color. You can take up to 50% of your balance, up to $50,000. So if you have 100 grand, you can get $50,000 for your down payment. We deal with a lot of first-time home buyers, 3% conventional, 3.5% FHA, and many of them have $40,000 or $50,000, and they only have 10 or 12,000 liquid, and they're like, how am I going to do this? In this situation, it's perfect because you're going to pay yourself back with interest. You're going to get a return on that money. You're going to not stress or worry about having enough money for your down, your closing costs, and you're going to be able to preserve some reserves, because when you get into that new house, there's going to be something you need, something that goes wrong. So you have to be prepared. You don't want to use every last nickel on the way in. So in terms of borrowing, $50,000 up to $50,000. If you're buying a $400,000 house doing a 3% down, maybe you only need 15 or 20. So I'm not even saying take the max that you can get. Just get enough to get you into the property with the minimum down and set up a 5-year repayment. 5 years down the line, you're going to have equity in your home. Your 401k will be built back up to where it was.
All right. Let's see, Josh. We got a couple here. Some of them are asking us to predict what's going to happen in the future. But let's just go with Kristen's question here for a moment. It says, what's the LTV when it comes to refinancing? Owner occupied, have a property in Fountain Valley. Comps are coming in lower than expected. So where do you need an LTV to be in order to refinance?
So same as a purchase. So if it's a conforming loan balance, 766, 550 or below, and we already have lenders jumping the gun and doing up to 803, guessing what the 2025 loan limits are going to be. So if you're 803 or below, 97%. If you're above that in a high balance area, Fountain Valley is high balance. Maybe you have $1 million, $1.1 million loan. You would be have to have 5% equity in the property. There's some limitations if you're at 97. If it was a Fannie loan, it may have to go back to Fannie. If it was Freddie, it might have to go back to Freddie. So we have to establish who the owner of the loan is. If it's FHA or VA, which Fountain Valley most likely is not, with those, the LTV doesn't matter. They're not requiring an appraisal. It's just a matter of, are we lowering your payment? So those are for rate and term. If you want to take cash out, it's going to be 80% or below.
All right. Vincent is currently sitting at an 8% rate and no PMI, has a school employee loan. So my guess is his school employee loan, that 8% is factoring in the MI. But nevertheless, says he has a rate lock at 6.1%. Still going to have MI on the loan. So you're adding some MI in, but asking, is it a good deal? So Josh, what do we need from Vincent to be able to determine what a good deal looks like?
He gave us a couple pieces of information that's close. $4,300 in loan costs, including the origination fee, saving around $500 a month. So this is the perfect example of what we're talking about. That is a 9+ month break even, but somewhere between 9 and 10 months. So I would do it. I would absolutely do it for $500 a month saving. That's real money. So we would do it. And if we get an opportunity in 6, 8, 9 months, maybe the value goes up a little more, maybe interest rates come down and it makes sense to do it again, then you would say, okay, I only made it 6 months. I saved $3,000 for the loan that I paid $4,300 for. It's a $1,300 insurance policy to make sure that I don't miss out on $500 a month of savings going forward the next 30 years. There's a couple things that I like to point out in there, Jeb. We talk about, don't laugh, Jeb. We talk about some of that savings is going from the original 30-year loan back into another 30-year term. So possibly look at keeping the term the same if you think you're going to be there longer term and building up equity is important to you. Do we need to save $500 a month? Could you save $400 a month and have that loan cost $1,500 or $0 or $2,000 and really compress that break-even period? A couple different ways there to look at it, but it sounds like it's kind of a no-brainer that you would do the loan.
Kim has another question too, or a question rather. She says $637,000 pre-approved price. She says $31,949 in closing cost. I have to think that's not right. But a 6.625% interest rate, asking our thoughts. So my thought is, if those are truly closing costs, that's not a great deal. If it is, on the other hand, that includes down payment, your FHA upfront mortgage insurance premium plus closing, all of that, then we're talking about a different number. I don't truly know what that 31,000 looks like, Josh.
Absolutely. So remember, on the loan estimate, the geniuses at the government, after like a 2-year comment period from the industry and the public going back and forth, they rolled out the loan estimate closing disclosure when they did TRID. But is it better? It's way better than what we had before, but it's really stupid that they give you a number that says closing costs. Well, closing costs is composed of loan costs plus all of your prepaids. So impossible to know here what this looks like, but if that includes the down payment, a 3% down payment at $637,000 is like 20 grand. But you do have multiple other things that could be in there. If it's an FHA loan, it could be the upfront mortgage insurance premium, even though it's financed, they're going to show as a closing cost and get added into that. Most importantly, what I would say, Kim has been with us for the entire 4 years or so that we've been doing this show. And about every year, Kim reaches out and asks us questions about the pre-approval that someone else did for her, despite the fact that she and I have talked on the phone and gone through this many times. So if you watch here every week and you like the value, we actually do get on the phone and talk to folks and go through that, and we can actually run through those numbers. So Kim, we see you all the time here. You know my phone number. I'm going to text you when we get off here and remind you that you have my phone number, and stop talking to other people, and we get you the answers directly.
There you go. Good stuff. This is a question or a comment, kind of a question and a comment, but I'm going to put it up here because I want to make a point of it, not to pick on pizza stuff, but it says, I have an interest rate for 6.5% on a $1 million loan. So they got 6.5%. Asking, is it time to refinance? They said they got the loan 3 months ago and they bought it down from 7.25%. So they bought it down, paid money to buy it down. Had they just taken the 7.2% 3 months ago, there was an opportunity even today, but a week ago, where you probably could have gotten that rate closer to 6% without any cost, like without paying down the rate. So when you're paying to buy down the rate, understand that is sunk cost. Now, if it's coming from the builder or if it's coming from somewhere else, then it's a different story. But if this is truly the money coming out of your pocket, be careful with, where you believe rates are going. Have a theory, a thesis, talk to professionals, figure out where rates are going before you do that. Because otherwise, you could be paying a lot of money and then you could have ended up with that rate in the future. So again, you got to do what you got to do. Sometimes people aren't educated on it, and therefore it's the decision made then and not looking out in the future. But you got to look a couple months down the road. So, and he said, or they said, we just realized that. So just take it into consideration. If you're paying down points, factor all of that in, because it could end up costing you money that you would end up saving at some point in the future anyway.
We talk a lot on the show about dealing with kids in the call center or a loan officer that just doesn't give a shit about you and your money. For the last month, I've been looking at loan estimate after loan estimate coming over that are really cavalier about spending $10, $12, $15, $20,000 of your equity to buy a rate down. It's real money. Even if it's just paper money, I don't have to write a check for it. I just see something moving in the ledger and my payment is going down, so it's still okay. We talk all the time. Be careful with your professionals. Like in this situation, someone should have penciled it out for you. Buying a rate down 0.75%, that wasn't like $5. That was a lot of points to get a rate moved that much. And that break even is a long, long ways out. In a more normal market where we have a rate sheet that follows that rule of thumb of 1.425% up or down either way, that break even is out at about 5.5 years. So when I say, almost every time when I go through the numbers, Jeb, with someone, I say, would you rather have a $112 lower payment or would you rather have $6,000 in your hand? I'd rather have $6,000. Problem solved.
Yep. No, for sure. Salvador says, how long do you have to wait to buy a second home after refinancing your first home? So Josh, I refinance, I pull some cash out. Is there a wait period on buying a second home with or without cash out?
Cash out is going to look painfully obvious to the new lender that you knew you were not going to owner occupy your current residence. You did it owner occupied to get the best terms, get your hands on the cash, and then you're going to turn around and buy another property. That's going to be difficult. I say it's going to be difficult. I've done one before where 40 days after we closed our refinance, we closed on a purchase. They literally were under contract within 2 weeks. I can vouch for those people. I actually know that they did not have any plan. The cash out was a plan to buy another investment property. While they were looking for investment properties, they found their dream home that they are still in today, 5 years later. We were able to find a lender, an investor who was willing to purchase that loan from us and do them both owner occupied. But if it looks painfully obvious to an underwriter, and they're going to be able to see, we have the mortgage, it's MERS, the mortgage electronic registration system. They can look at your loan and know that it was done as an owner occupied. So if you're going to do cash out owner occupied for $100,000 and magically you're putting $100,000 down on another property 6 weeks later, not going to be super easy to find a lender willing to do that. So what is the appropriate amount of time? 6 months, you might be able to make a better case for it. 12 months. I would love to know more about the story. What type of home are we trying to buy? Are we downsizing? Are we moving 2 states away? There are things that can make it make more sense versus, hey, I'm just buying a nicer house 2 blocks away from where I'm at right now.
Good stuff. So Pizza Stuff came back and asked a question. So is it time to refinance for us now, or should we wait? My advice is to wait. You paid a bunch of points down. If you got a rate today, it's not going to be significantly better than what you already have just because of where rates move back up. But here's what I would suggest. Anybody, if you have a loan now and you're thinking, I want to refinance in the future, maybe you have a 6% rate and you need rates to go down to 5.5 or even 5%. Have the conversation now. Find a lender that you're comfortable with, a professional that you want to work with. Have the initial conversation, tell them your goals, and get on a list. Not a list where they spam you every day with their marketing messages like I do to people, but rather, but rather,
I don't want to watch that guy's new video.
But rather a list where they keep you updated on where rates are. So if you know you need to get down to 5.5, when rates get down to 5.5, that person calls you and said, hey, guess what? Congratulations. Rates are at 5.5. Do you want to rate? I mean, do you want to lock or do you want to wait for rates to go lower? What do you want to do? That way you don't have to pay attention to it. It's already baked in and that professional's taking care of it. So that said, Pizza Stuff, find a lender. If you need one, that referral link will get you to somebody. Josh on our team, Josh here, and a team can help you out. If it's outside the area that we cover, we got David that can take care of you. But either way, whether it's us or somebody else, talk to somebody now. Get on a list. That way you don't have to continually ask the question of when and how and all that good stuff.
And within, so a couple things here. Within the next week, we're going to have a tool that we can automate. We have a conversation and we say, okay, I talk to people, Jeb, that were at 5.875. And we're like, rates are great. They're not that great yet, but they're likely to be at some point, whether it's 6, 12, 24, 36 months down the line. So let's look at the numbers with your loan size, the closing costs in your state. Where would we need to be for you to go, oh, hell yeah, I want to refinance? Cool. We're about a week away from having a system where we can plug in your name, email, loan type, and it watches the market every day and it pings both of us. Hey guys, it's go time. It's ready to do that. So if you're interested, want that, definitely use that link, reach out, just say, hey, I don't think you can actually put in that form and just in the note say, hey, I'm not sure it makes sense right now, but would love to get on the watch list. We can do that. But the thing that you said, Jeb, in the first answer to his question or their question was sunk costs. Sunk costs are irrelevant. If the rate was 5.5% today on that $1 million loan,
yeah, you've already paid it.
I don't care. The points are gone. You're not going to save. You would lose more money by staying in that loan versus refinancing lower. So the question just becomes, when does it make sense to go from this loan to the next loan in terms of how much money am I saving? How much does that loan cost me?
All right, good stuff. Night Panda just says, hey, are you seeing AI tools in the real estate purchase or lending changing how you conduct your business? Yeah, I mean, Josh and I both use ChatGPT, Gemini, a couple different variations of different tools that help automate things. Is it changing the business entirely? I don't think, not yet. It definitely has the ability to make things easier to get information, to disperse information, to, like Josh said, you fill out something, it's automatically updating us. Like AI can do a lot with that sort of thing. Is it going to take Josh's job? No. Is it going to take my job? No. My job for sure. It's too emotional. I did like going through the home buying process, thinking that AI can handle like people's emotions is crazy. But at some point, maybe. I mean, depending on how far it goes, but we're not there yet.
Well, it's funny, Jeb. I was going to tell you today. We were back. You guys have heard us talk about United Wholesale Mortgage. I went back to the mothership in Michigan 10 days or so ago, and one of the big things they did is brought it in and walked us through Chat UWM. So you've heard about big companies that have all of this internal knowledge in PDFs, in guidebooks, handbooks, emails. Well, they had, and I don't know if it's a GPT or another vendor, but basically they trained it on all of their internal documentation. And we used to have to go and say, whatever your question is, what's the max LTV on this? What's the FICO requirement on this? What are your lock desk hours? And that AI can answer anything with a clear answer and a link to that document in like 0.2 of a second. And it's like a night and day difference between what it was like, because you used to have to really think about how am I going to ask this question? And then you had to filter through 20 responses, kind of like a Google response versus this AI going, here's exactly the needle you were looking for in that haystack.
No, with that said, my company, Real Broker, the real estate company that I'm with, we have AI built into our platform, Reason, and like we can go ask it questions and it gives us answers. So it doesn't have 100% of it there, but I would say a good percentage of it. And when people, it gets smarter every day with the more information that goes in there. So that part of it's really cool. It just makes automating things and finding information quicker. So yeah, good stuff. Don't Sell says, what's your opinion on buying a single family home with an attached garage, converting it into a casita or ADU? I think it's a great deal. If it makes sense.
As long as you don't have a car or like parking it inside.
Yeah. I mean, no, honestly, it is the next thing. Like it's the next opportunity to add equity to your house without having to build a whole nother structure. I mean, but you have to, I think people underestimate the cost of it. They underestimate the timeline of it. They underestimate in many cases what it increases in value. So just make sure you're factoring all of that stuff in there. Because it is something that goes into the equation. Remodels, rebuilds, everything. The costs are always underestimated, always. And I think even more so on ADUs because people are like, oh, it's a small thing. It's not a big deal. Well, you got plumbing, you got electrical, you've got, all of that. Plus, you got permitting costs. You got all of these things need to be factored in. So just make sure it makes sense. I mean, that's but at the end of the day, if you can do it and make sure the lot's big enough, right? Don't cram it in a small lot because you're going to end up hurting yourself when you try to resell it at some point in the future. But those are the things I would think about.
And I'm the absolute wrong person to talk about on that one because the idea of living without a garage would be awful.
Yeah, no, I get it. Yeah, I mean, I just sold a house in Westminster. It had a detached garage and it had a shed behind it. And I think the owner, the new buyer, we just closed it yesterday. The buyer that is buying that property they want to turn one of them into an ADU. So probably the shed, which is big enough to do it, and then they'll have a garage still. So
it's a fancy shed.
Yeah, and you could also keep your garage in some cases and add a second level to the garage. In this case, there is enough room there. You could have a small ADU above the garage and you still park your car in there and have a unit upstairs. So there are opportunities for sure. David says, will ChatGPT take the jobs of housing crash content creators? You know what? Probably. No, it's interesting because ChatGPT definitely I can tell the content creators, well, not all of them. I can tell a good portion of who is using different platforms out there to create titles for videos and different things because of how they're titled. Because the platform doesn't really know what YouTube wants to see to some degree. And I know how ChatGPT throws titles out there. So you can tell there's a lot of creators using ChatGPT and other platforms to help with that content. And it's only going to get better and more advanced. And soon enough, it might not even be me talking. You might just have my face with words moving.
The content creation is the hard part because honestly, before listening to any moron telling you that housing's going to crash for the last 6 years, or anyone telling you that housing's never going to crash, large language models, large data models, they could pull all of the data in going back prior to the 1950s. There wasn't really a homogenous market to really analyze, but from 1950 going forward, we've got 75 years of data that an AI could probably give you as good of a projection of future values as anyone, given the right inputs and the right things to look at.
Yeah, it's all about the input. With that said, guys, we'll be back next Wednesday to update you on everything housing. If you haven't done so already, do us a favor, hit that thumbs up if you found any value tonight. If you're not subscribed, consider doing that. But we'll talk to you next week. Until then, adios.
Amigos.